liability. And these are very simple accounting terms, and again, I don't spell very well. So if I could explain very quickly why most people's houses are not assets. I'm not saying don't buy a house and don't have a dream house. I'm just saying know the difference in assets and liabilities. Because when you look at a financial statement, and this is my rough draft of one, this is the basis of financial intelligence, the basis of your financial IQ. This is why your banker asks you for your financial statement. Your banker does not ask you for your report card. The banker does not give you great grades or what school you went to. The banker wants to see your financial statement, income, and balance sheet, because this shows them how smart you are financially. This is more sophisticated than just, your credit score. But anyway, financial statements has income, expense, asset, and liability. So when most people buy a house, liability, when most people buy a house, what you have here is a mortgage. And it looks like you have a house here, which is an asset. But that's not really accurate. What determines if something's an asset or liability is the most important word in financial intelligence, and the word is cash flow. And we ask any accountant how important this is. So as a young boy, my rich dad very simply said, assets put money in your pocket. Cash flows into your pocket. And a liability takes money from your pocket. So if you're truthful about it, you say, well, does my house take money from my pocket? And I would say for most people, every month their house takes money from their pocket. And then the savers say, but my house is paid off. I don't have a mortgage on it. But you still have expense, insurance, and upkeep. So the house is taking money from your pocket. So my point here is this. If I have a house and money is flowing out of my pocket, that house is a liability. So my personal residence, my home, is a liability. Now, I love my house. I want you all to have your dream houses and all this. But I don't call my personal residence an asset. It's a liability. It's about $15,000 every single month. Whether I make money or not, the bank still wants to get paid, taxes still want to get paid, and all this. Now, if I have an apartment house or a single-family house, and every month my tenant pays me money, then that same house is an asset. So now, let's say the tenant walks out and stops paying me. That's when the house turns into a liability because I have no money coming in. So it's very simple. Rather than just say my house is an asset, you have to know today in the new rules of money what's an asset and what's a liability. Very simple rules are assets put money in your pocket and liabilities take money from your pocket. So when I ask most people, if you stop working today, how much money keeps going out? Where that money is still going out, it's a liability. And if you stop working today and money keeps coming in, that's an asset. Money is coming into your pockets. Assets put money in your pocket and liabilities take money from your pocket. The reason my wife and I could retire when we did at a relatively young age, we had more assets than liabilities. The reason people are in trouble today, they have more liabilities than assets. So if you're going to be rich today, don't just say my house is a good investment. You have to ask yourself, is my house an asset or a liability? My wife and I have two houses, one regular residential house, one vacation house, but we have I think we have about 1,000 to 1,500 apartment units that every month put money in our pocket. We also have stocks that put money in our pocket. We also have oil investments that put money in our pockets. So I work very hard at acquiring assets and minimizing liabilities. And that's the lesson on why the new information, the new rules are you must know assets versus liabilities. So the next old rule, new rule of money I want to talk about is one of the nastiest four-letter words in most people's vocabulary, and that four-letter word is debt. And every expert will tell you, get out of debt, get out of debt, get out of debt. Those are old rules. To be up to date and with time, especially since after 1971, you've got to know today that there's both good debt and bad debt. And the reason most people are in trouble is because they have too much bad debt. And as from the example of assets versus liability, it's a very simple thing. Good debt makes you rich because it puts money in your pocket, and bad debt is bad because it takes money from your pocket. So I have a house and I'm paying it off and all that stuff, but my house is bad debt because I got to pay for it. Good debt is debt that somebody else pays for me and makes me rich. So if you really understand money and have a higher financial IQ and invest your time in this, your greatest asset, you'll know that you can use debt to get rich, especially today. One of the reasons, that when you look at what happens to most people is, again, if this is an income statement, expense, asset, and liability, the reason most people are in financial trouble is they think they buy a nice house, so they buy this big house, but they have this thing called a mortgage. And nothing wrong with a mortgage, but the word mortgage, if you understand financial literacy or the definition of the word, mortgage means death, mortgage, the death of your future age. So you have to know when to use debt and into the good process. So what happens to most people is they go to school, like they were told, they get a job, their first big line item expense is taxes because they're an employee or self-employed, and the second line item expense is called mortgage payment. So the money is just pouring out of their pockets this way because they have bad debt. Now, as an investor, because I took a real estate course years and years ago, and my rich dad taught me, is I own a house here. I have a mortgage for it. But every month, I don't pay for that house. My tenant, bless her soul, pays me money, and that money then pays the mortgage and all this stuff off. So I am a wealthy man because I have lots of good debt. And I get richer and richer because I use debt. If you understand tax law, debt is tax-free. It's wonderful stuff. There's another thing about knowing how to use debt to get rich. The reason most people are in trouble today in the real estate market is because they were flipping properties. They were trying to buy it and sell it for income. That puts you in another category. I buy and I hold and I use the cash flow, and cash flow is passive income, which is taxed less. So there's so many different reasons why a high financial IQ, part of your learning is to understand good debt and bad debt. If you're the old thinking, you might think all debt is bad. That is not correct. Today, you have to know good debt and bad debt. There's one more thing I think that's really important. I said earlier that savers were losers. I believe, and I could be wrong, that in the near future, the debtors will be the winners. And the reason for that is, for example, I just bought an apartment house, and let's say I paid $20 million for it, and I have a $20 million mortgage on it. Well, if they keep devaluing the dollar, I'm going to be paying that $20 million off with dollars that are worth less and less and less. So people who have good debt become winners because after 1971, I can pay it back with junk dollars. Now, if you can understand that, you might understand why, to be a smart person in the 21st century, you need to know good debt versus bad debt. That takes a little education, a little reorientation. So it is unfortunate, because of 1971, when Nixon took us off the gold standard, savers became losers and debtors became winners, but debtors who have good debt. So the last thing I want to talk about debt is one of the best investments I made, because I started off with no money like most people. My first investment was a little $18,000 condo in Hawaii, and I made a whopping $25 a month. I didn't make much money on that deal, but every time I did an investment, be it real estate or business, I got smarter, because experience makes you smarter. So I started with just a little $18,000 unit. I broke out my credit card. I paid the $2,000 down payment with my credit card, so it was 100% finance. Now, most experts will say you, that's stupid. You don't do that. But if you know what you're doing, you can do it. A number of years ago, I bought a $7 million commercial building. I paid for it with zero down. And every month, after everything is paid for,